Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the world of corporate filings. Today we're going to be looking at Super League Enterprises' latest quarterly report. It's a wild ride filled with financial struggles, potential NASDAQ delisting, and of course, good old business strategy. You almost feel bad for them. So let's get into it. We're going to break down the key numbers, the challenges, and what it all means for this company's future. And before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss filings with other investors. Let's kick things off with the heart of any quarterly report, the condensed consolidated financial statements. We will keep it quick. This isn't pretty for them. First up, let's look at how much money they're actually bringing in. The accounts receivable, Super League's accounts receivable decreased from $3.7 million. That means they're collecting less money coming in, less money for the company. On the other hand, their current liabilities, which represent short-term debts, increased from $10.40 million. They owe more and they make less, not great. And finally, let's look at the bottom line, which is the net loss. Super League's net loss isn't pretty. We're looking at a $4.22 million loss from last year, but still losing money. All right, now that we've got the super quick summary, let's get back to start and go through the main details. Revenue for the 3 months ended in March was $270, and the $427 million they made around the same time last year. This is attributed to industry softness and the sale of Minehut. It's important to see where the money comes from though. They have 3 revenue streams with media and advertising is from direct to consumer. Most of it comes from media and advertising is from direct to consumer. Most of it comes from media and advertising is from direct to consumer. Most of it comes from media and advertising is from direct to consumer. Most of it comes from media and advertising is $127 million. Comes from publishing and content studio and direct to consumer. Most of it comes from media and advertising is from direct to consumer. Most of it comes from media and advertising is from direct to consumer. Most of it comes from media and advertising is from direct to consumer. The vast majority is from ads. What matters even more is when the revenue is recognized. 53% of the revenue is recognized over time, meaning through longer contracts, while 47% is point in time, meaning it's project based and changes quickly. Now let's move on to advertising, where they tell us how they spend their advertising dollars to make money. They mentioned that $18,000 was spent on advertising, a tiny amount compared to last year's $43,000. It's important to know that they mostly rely on social media, prints, and marketing, and these costs are expensed. And they also mention how they deal with engineering, tech, and development costs. Mostly it's the cost of salaries, benefits, software amortization, cloud service, etc. In simpler terms, it's what they pay people and services to keep their platforms running and up to date. Accounts receivable, which is how much money they expect to come in, is not bearing interest, which is good. The health of their customers is reviewed constantly to evaluate the possibility of potential credit losses. And they look at receivable balances, history, credit quality, and economy. So far, it is all well and good. Now it is time for the fun part. It's that one paragraph that appears in every single report, but it contains important information about how the company works, the use of estimates, and what management estimates. It's a very long paragraph, so I'll make it short. Management needs to make some estimates for revenue recognition, impairment of intangibles, and stock compensation, etc. Any difference in management's estimates can heavily impact the financial results. Now we get to the intangible assets, and there is a lot of them, like customer relations, software, capital influences, trade name, domains, copyright, and other. So what are intangible assets? I mean, they're not physical things like buildings or equipment, so what are they? Well, customer relationships represent their connection to their clientele, their Rolodex of business contacts. Software reflects the value of their custom code and platforms. Influencer contracts that they have also count toward this value. Amortization is being done throughout 10 years for them, so they go into even more detail how they determine the gain or loss when selling intangible assets. Then it gets interesting. Minehut comes back from the dead. Well, kind of. They mention the sale of Minehut assets and how some money is yet to come in. All of it depends on the deal made with Gamersifer and some royalties that haven't been received yet. They will reassess this calculation, and it's a probability calculation since the royalties might not come through, so that means that future gains may be realized on the deal if Gamersafer hits it big. But the opposite is also true. So let's talk about it. What is goodwill? It's not physical or easily tangible. Its value is basically the extra amount a company pays when buying another company above the acquired company's actual worth. So why would a company pay extra? It's because of things that are hard to put a concrete value on, like the brand's reputation or solid customer relationships. Let's move on to stock-based compensation. This is how companies pay their employees, by giving them stock instead of cash. It's measured by how much stock they give over the time they work there. In terms of expenses, the company had a total non-cash stock compensation expense of $284,000, where about $200K went towards general and administrative. Now let's look at all the details of debt, how it's accounted for, estimated, and what happens when a company can't pay it back. There's a lot of discussion about the fair value option election, which basically means they choose to measure some of their debts at current market value rather than historical cost. This can give a more up-to-date view of their financial obligations, but also introduces fluctuations based on market conditions. For the current quarter, they expensed 122 fluctuations based on market conditions. Up for the current quarter, they expensed 122,000 due to proposed debts being deemed not likely to complete. That's money down the drain. The section ends by talking about what is actually more important, that accounting, the actual debts. The company states proceeds from notes payable are $3 million and $2 million were used to repay previous debts. This means the company is barely balancing its debt and is rolling it by acquiring more debt to cover the older. A summary of the changes in cash flow is then followed. And some more notes. One is about settlement of a litigation where they are paying $924,000 in shares to someone related to legal trouble from the last period. We can find the full details in the original filling, but it's most likely very boring. The last section goes into recent accounting guidance, basically mentioning that in the future companies need to disclose additional income tax information in a more transparent way, and talk about some future accounting statements. This section is all housekeeping to make sure everything is correctly accounted for. Not much to dig into here unless you are a CPA. We now get to management's overview of their situation. First, they're trying to ease people in a bit. They mention positive effects to earn money and positively impacted operating leverage. So in a way it is improving, just not so much. Let's check some of the results of operations. Total revenue decreased by 35%, and the decreased revenue is related to crafts, Lunchables, custom game experience. It is very important that you note that a net loss of around 4.2 million is reported, so we are still in a loss. This also causes the famous going concern problem to arise, where it is no longer guaranteed that a company can pay its debts, keep afloat, etc. Management says that it depends on their abilities to execute business strategies and the conditions for raising additional equity, financing on acceptable terms. It is then explained about recent financing activities, like the issuing of promissory notes and common stocks. It's again just rolling the debt over, getting smaller loans to pay for older ones. The diagonal lending one is very predatory. A 10% per annum that is turned to 22% if the borrower doesn't respect certain things and has additional penalty fees if certain events happen. A very similar thing goes on with the Bello note. It is a very high interest debt financing, 20% with additional fees. Afterwards, they explained the equity purchase agreement with Hudson Global Venture, where Hudson will help finance by committing to a purchase. The company sold 717,000 shares. A public offering was also made where 5,117,647 were sold at 0.17 cents per share, resulting in a very small 700K after everything was accounted for. Then comes the scariest part of all. The company is not complying with the minimum bid price, has missed to report annual numbers, and has a lack of equity. That means that they might get delisted from the stock exchange and go to the OTC, which would heavily reduce their evaluation and make it harder to trade stocks, and they are monitoring it and are trying to regain compliance with NASDAQ requirements. All they have to do is get a $1 per share price for 10 consecutive business days, or they will be delisted. Finally, as always, the legal mumbo-jumbo about compliance, risks, and how the document was made. Nothing too serious, so that completes the analysis of the filling. Now, let's step back and look at the big picture. Super League is fighting an uphill battle. While they're trying to innovate and connect brands with gamers, their financials tell a story of struggle. The company has a few strong traits. Management's ability to secure financing to keep afloat is amazing despite the business weakness. They have clear sales and know how to market. It is a competitive industry, so that has its challenges. But the weakness is also very apparent. There are many contingent liabilities, and they depend on receiving royalties. Their debt obligations require constant new loans. In an apparent rollover in exchange for high equity dilution, they risk being delisted, which in turn creates even more problems. What are the opportunities? The space of digital advertising is only growing, but so is the amount of competitors. So who knows what will happen? So it's a wild ride. Is this stock a definite no-go at this point? Not necessarily, but there are huge risks that you need to very carefully consider. Don't put your life savings on it, that's for sure. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.